going over problem 10.3b, and I believe on your homework you have problem 10.3a. So it's going to be very similar. So again, if you remember, we are in liabilities. So liabilities are things you owe, and this one is talking about a notes payable and accruing interest, so interest payable. And if you recall, the matching principle says I have to record interest in the year that the interest is owed. So even if I don't pay it today, I still have to accrue it in 2017, even if I'm not paying it till 2018. So the first one, we're going to record the transactions, and then we'll talk about those later. But borrowed $20,000 from the bank, so what did I get? I got cash, and I got it by signing a notes payable. So I debit cash, credit notes payable. Notes payables are liability. Next one, I purchased office equipment from Moontime Equipment. The invoice was $30,000. They agreed to accept a 10% note for the invoice. So notice I don't always have to get cash for equipment, so I can sometimes get office equipment for, don't always have to get cash from a notes payable. Sometimes I can get another asset. In this case, office equipment. The next one, I paid the bank the note plus the interest. So Weston Bank, so I need to figure out which one is Weston. It's the $20,000. So this is July. So I've got the month of July, August, and September. So I've got 3 months. So the formula for interest is principal times rate times time. My principal is $20,000. My rate is 12%. And my time is 3 over 12. So let's talk about that first. I know I'm going to pay off the notes payable, so debit the notes payable to get it off your books. Plus I'm going to pay interest expense that I need to get in year XX. So principal times rate times time is 12,000 times 12% times, I would have just done 3/12 instead of 90 over 360. It's $600, so I'm going to pay back $20,600. I now borrowed $100,000 from Gene Jones, a major corporate shareholder. The corporation issued $170,000, 5%, 120-day notes payable. Okay, so I borrowed it from her, so I have a notes payable, and I got cash. So cash and notes payable, so no different than the first one, but I've got a 120-day loan at 5% interest. And remember, interest is always, always, always stated on an annual basis. That's why I have to take 90 over 360, and that has to do with federal truth in lending laws. Next one, I purchased inventory in the amount of $10,000 from Listing Corporation, accepted a 90-day 12% note as settlement of the purchase. So in this case, I didn't get cash, I got inventory instead of cash, and I have a notes payable. So again, I just don't always have to get cash. And this one is 90 days, 12%. The $30,000 note to Moontime Equipment, so that's this one up here. So notice it was September 16th, and a 3-month note. So I've got September, October, November, September to October, October to November, November to December. That's 3 months. So I paid it off plus interest. And so, let's see, matured. They paid the accrued interest on the note and issued a new 60-day 12% note payable in the amount of $30,000 to replace the note that matured. So in other words, I flipped a notes payable to a notes payable and paid the interest. I probably would have done this in 2 entries instead of one. One where I debit notes payable for $30,000 and credit notes payable for $30,000. And then the separate one to show I paid the interest. And again, interest is principal, $30,000, times rate, got to go up here, 10%, times time, 3/12. So I've got September to October, October to November, November to December, 3 months. And so, again, I would have split this into 2 entries. You can do 1 entry, you can do 2. So interest expense and cash is I paid off the interest, and I flip-flopped one note for the other note. You can figure out why in the heck do I do that when they're going to the same account. But remember, a lot of these accounts, like inventory, equipment, have a subsidiary ledger that keeps track of the exact one. So this note payable has a different maturity date, and in your subsidiary ledger you're going to have that. Okay, so that's actually our regular entries. Now I have to do my adjusting entries. So if I had made some T accounts of all the notes, this one was paid off, so this one's gone. I don't have to worry about that one. This office equipment of $30,000 is, I actually paid the interest and got a new one, so this actual one is gone. This one is where I paid off that one. This one, the $170,000, I still owe on it, so it's still outstanding. I still owe on this one, so it's outstanding. And I still owe on this one, and it's outstanding. So I've got these three. So I've got notes payable of $170,000. So principal of $170,000 times rate 0.05 times time. So look, it's December 1st to December 31st. I'm just recording for the year I'm adjusting for. So I don't care that it's 120 day. I'm making this entry for the year XX. So for the year XX, this was outstanding 1 month. So principal times rate times time, 170,000 times 0.05 times 1 divided by 12 is 708. This one, again, is also for 1 month from December 1st. So I have principal of 10,000 times rate of 12% times time of 1/12. And so I've got that one totals $100. And this moon time equipment, this date, which is not showing, was the 16th. And so over here, I will never have you split a month, but again, principal is 30,000 times rate of 10% times time is actually 0.5/12 because it was December 16th. So if you look at your adjusting entry, and we'll go down and look through the individual ones. So this is my 170,000, 708, my 10,000 of 100, and then the last one of, they did 1/12 times 1/2. I said do 0.5/12. You get the same number. If you add the 708 plus 100 plus the amount on this one, I don't have it in front of me what that is, but they all three add up to 958. So you have interest expense and interest payable. The last question is why the new 60-day note payable to Moontime Equipment pays 16% of interest instead of 10%. Well, possibly the interest rate could have simply changed in that time period, but also the fact that they didn't pay it off, the risk has increased, so you might charge them a higher interest rate. So hopefully that helps.